And so for those that are out there, a home equity line of credit is like having a second loan. It's actually a lot higher than the interest rate that you would have on a first, but because they didn't have any a first loan, right, it made it a lot easier. Back in the early 2000s, or in the the early 2000s, before the crisis, a lot of people were getting HELOCs, as we call them, on their home for the exact same thing, but they were significantly higher and they had a first mortgage. And if you're unable to pay the first mortgage plus the HELOC loan, that was putting a lot of people at risk to actually lose their home. And in your situation, you're saying you had a mom and dad that paid everything off. So that's a beautiful thing. And then secondly, they trusted you that you could actually do this. And they could trust you because you had your first home that you had fixed and renovated and was renting out. So they were able to see track record, right? And so this private money lender, if you will, that was family, which a lot of people do get their start from, was able to see that you were able to make it happen, and they trusted you. That's really good. That's a very good situation.